America is in panic. Japan debt bomb is ticking. What happens when the most indebted nation shakes global financial stability right now? Not someday, but today. What if the dollar weakens, bond yields surge, and your portfolio is pulled in without warning? This is not a theory. This is happening now. These first 30 seconds matter more than this entire financial year. Japan's 30-year government bond yield just reached an all-time high, the highest since its creation. Pause for a moment. Think about that carefully. A market once seen as untouchable is now starting to crack. And here is the shocking part. The United States Federal Reserve has stepped in to support the yen. America, issuer of the global reserve currency, is supporting another nation's money. If this feels wrong, your instinct is correct. This is no longer about the future. This is the present moment. When a government supports foreign currency, old rules are breaking down, and the price will be paid sooner or later, almost certainly through a weaker dollar. If you do not understand this, your investments are exposed. Your retirement savings, your long-term plans, all are affected. Japan's debt crisis is now triggering a massive carry trade reversal, a mechanism rarely discussed, yet globally powerful. When this reverses, United States Treasury yields do not rise slowly. They jump, and they jump fast. This is not textbook finance. It is not widely taught, but it is driving markets today. This is not about who warned first. This is about what to do now. I have said before, Japanese bond yields would surge. That has now happened. The 30-year yield is at record highs. I warned of pressure on United States markets. The Standard & Poor Index fell about 2%, over $1 trillion erased. I warned banks would suffer. Major institutions began falling. I warned the Treasury would panic. That is exactly what we see now. Direct calls to Japan, attempts to calm the markets, and the Federal Reserve intervenes. This is not coincidence. It is consequence. What matters next is not just understanding Japan. It is understanding your money and how to protect it. Before this accelerates further, we are early in year 2026. This story will not disappear. It will unfold all year long. Japan faces the worst debt burden among major economies. Debt to gross domestic product is about 250%. 250%. That number sounds unreal. For comparison, the United States sits near 120%. And that is not discipline either. Imagine earning $50,000 yearly while owing $125,000. That is Japan. On a national scale, for over 30 years, they paid almost no interest. A financial experiment without precedent. Some call it a modern Ponzi structure. And the world accepted it as the new normal. But the normal is breaking. Last December, the Bank of Japan raised rates, the highest since 1995. The rate is still small, about 0.75%. But the meaning is huge. For the first time in decades, yield control was abandoned. They stopped buying bonds. They started selling. This is not a tweak. This is a regime shift. At the same time, the Prime Minister is pushing massive new government spending. The bond market responded immediately, and with deep skepticism, decades of spending with little to show. And now the solution is to spend even more. The contradiction is obvious. An early election is called to secure approval. And let's be honest, asking voters if they want more money already answers itself. The promise is broad tax cuts. But the core question remains, how do you pay for this when debt is already overwhelming? The answer offered is reassurance, trust that it will work out, without issuing more debt in a year where financial assumptions can change overnight. Understanding this story is no longer optional. It is essential. Otherwise, you risk paying the price after the market understands it. The bond market answered very clearly It did not believe the reassurance at all. Yields reacted almost immediately. They moved sharply upward. Since this issue was last discussed, Japanese bond yields rose about 10%. That may sound small at first. In bond markets, it is massive. It is a true financial earthquake. Moves like this are extremely rare. They often happen once in a lifetime, if they happen at all. When bond investors panic, the damage spreads quickly. What follows can shape your finances for the next decade or more. Right now you may be thinking, I do not own Japanese bonds. Why should this matter to me? The answer is scale. Japan holds roughly $122 trillion of United States Treasury bonds. That figure exceeds the entire output of many nations. Japan is the largest foreign holder of United States government debt. For 30 years, Japanese investors bought American debt without hesitation. The reason was simple. It looked like free money. They borrowed yen at nearly zero interest. They converted to dollars. They bought United States treasuries. Yields were 4 or 5%. Currency risk was hedged. The spread was pure profit. This was the carry trade. But the foundation has cracked. Japanese yields are no longer near zero. They climbed toward 3%. Recently, they touched almost 4%. Now the question becomes obvious. Why take currency risk abroad? Why pay hedging costs for a fraction of extra return? A rational investor would not, and they are not, this is why capital flows into the United States are slowing over time. Hundreds of billions may begin to reverse. Even trillions of dollars could flow back home. More than $20 trillion linked to these positions may start to unwind. This is the real reversal of the carry trade. Large macro shifts like this always create risk. They also create opportunity, but only with the right framework. In a year when financial views can change very quickly, listening carefully matters more than watching surface numbers. Some will argue that $1 trillion is small versus total United States debt. America owes nearly $38 trillion. It remains the largest economy. That is true, but this is where danger deepens. Hedge funds are deeply involved. They saw what looked like an obvious trade. Several percent return, almost no perceived risk. It was boring, but highly scalable, and that is what they do. No one knows the true size of these positions. Hedge funds do not disclose strategies. Estimates suggest total exposure with leverage may reach $20 trillion. Leverage was extreme, 10 times, 15 times, even 20 times. If it worked, profits were enormous. If it failed, history suggests the cost was rarely theirs. We learned this lesson from the banking system. Now these positions are being forced to unwind. That means selling United States Treasury bonds. It means buying back yen. It means cutting risk everywhere. When this process begins, markets do not adjust gently. They break violently. We have seen hints before. A sharp shock in August was it 2024 or 2025. Even time itself has become hard to track. That is often the signal a larger cycle is forming. When the small correction appeared, the real picture looked very different. Bitcoin lost more than 20%. NASDAQ fell around 10%. The Standard & Poor index dropped close to 8%. It was not an easy week unless you understood it beforehand. Many still believe they were not part of this trade. They do not trade carry strategies. They barely understand the concept. That sounds reasonable, but the truth is uncomfortable. You are already inside the storm. If you hold the Standard & Poor index directly or through retirement plans, you own companies like Apple, Meta, and Microsoft. For an average worker, it is almost unavoidable. Technology stocks rose for years, not by magic. They were fueled by cheap capital, low-cost debt, by your real estate value, and even your home mortgage. When treasury yields surge, mortgage rates follow immediately. Digital assets sit at the far edge of risk. When hedge funds are forced to sell, they do not sell selectively. They sell everything. Margin calls appear. Risk must be cut to survive. When they sell, your assets fall as well. You are affected, whether you see it or not. This is the part that truly unsettles people. According to Bank of America, fund managers control most market flows, roughly $175 billion. Nearly half of them have no downside protection. They are fully long, fully exposed. They assume markets only rise. Everyone is on the same boat, and the boat is tilting. The situation worsens. When we look at Europe, European investors hold about 40% of all foreign-held United States Treasury bonds. That equals roughly $8 trillion. This is twice the combined holdings of China and Japan. Europe is running out of money. Defense spending must rise sharply. The obvious question is where the money comes from. One option is selling United States government debt. That places the Treasury in a difficult position. On one side, Washington urges Europe to spend more on defense. On the other side, if Europe sells treasuries, United States interest rates surge and growth slows. These are not good choices. The calming tone from leadership should worry you. Recently, the Treasury Secretary spoke at the World Economic Forum. His message was simple: stay calm, breathe deeply, let things play out. He said he contacted Japan and expected calming statements. Words to soothe markets, not actions to solve problems. When the Treasury Secretary hopes for reassuring words from abroad, the adults are nervous. Now, there is one concept. Many people do not grasp, even many advisors miss it. It is called correlation breakdown. In normal times, stocks fall, bonds rise. This supports the classic 60-40 portfolio found inside your retirement plan. But when government credit comes into question, that relationship breaks. Stocks fall, bonds fall too. Diversification disappears. You suddenly face nearly full risk. Ken Griffin explained this clearly. When bonds and stocks move together, bonds lose their special role. Your hedge no longer works. That is why people search for alternatives. Market strategist Michael Purvis says gold can offer protection. That helps explain recent gold and silver moves. Their charts look chaotic. They delivered gains for some investors. They may go higher with volatility along the way. But this does not mean put everything into metals. The key is understanding the framework behind events. Once you see it, you can protect yourself better. You can make clearer decisions as the next phase unfolds. The goal is not fear. Panic never helps. The goal is the full story, without simplification, not headlines, but structure. In a year where views can change quickly, listening carefully may matter more than you think. Everything may look fine on the surface. Mistakes happen to everyone in markets. But when a respected bond investor speaks, people should stop and think carefully. He rarely suggested holding large cash positions, yet now he openly does. This alone signals rising uncertainty. Not a casual defensive comment. He understands bonds deeply. He lives inside that world. Some observers do not fully agree with holding too much cash. Cash carries its own hidden risks, especially during inflationary periods. Purchasing power can slowly erode without being clearly noticed. That is why some diversification matters, if it fits your personal situation. Gold and silver may play a role when risk tolerance allows it. The key lesson is independence. Research, think, and decide yourself. That is real risk management, not copying famous opinions. Eventually, ignored issues surface and reality enters the room. The deeper message is simple. Never trust blindly any single asset. Not bonds, not stocks, not even the largest economies. Confidence must always be questioned. When central banks must intervene, stress has already grown serious. The question becomes preparation, not prediction. A practical approach starts with indicators, not emotions or headlines. The 10-year Treasury yield matters greatly, especially in the Pacific region. It sounds boring, but it drives financial conditions. At the same time, review your portfolio honestly. How much is truly defensive and how much is pure optimism? There is no need for panic or rushing fully into cash, but rebalancing toward quality matters, especially during uncertain phases. History shows an interesting pattern. Value investors often look foolish first, right before they appear wise, when cycles finally turn. After global cooperation weakens, defensive strategies gain importance. Energy materials and precious metals often return to focus. High-quality technology also belongs here. Despite recent difficulties, many strong technology firms struggled recently. That may improve future prospects. Nothing is guaranteed, but strong businesses endure. They retain pricing power and competitive advantages. Essential consumer companies also matter. Boring yet reliable survivors. Caution is needed with banks, especially smaller regional institutions. Bond losses can severely hurt them during volatile periods. Highly leveraged companies deserve scrutiny. Debt amplifies every mistake. Luxury goods and discretionary spending fall first. When pressure builds, speculative technology demands extra caution. Excitement increases hidden risk. Technology remains vital long term, especially artificial intelligence development. Government spending may support growth over extended horizons, but unmanaged risk destroys portfolios. More than slow growth, you must control risk, not let risk control you. Real estate shows double-edged behavior. Benefit and danger coexist. Policy rates may fall, yet mortgage rates still rise. Markets decide long-term rates, not governments alone. That is why bond yields matter, especially the 10-year benchmark. Certain levels act as warnings, not predictions. High yields signal rising stress across the system. Currency volatility can escalate quickly. When balance breaks, geopolitics often intervenes unexpectedly, changing theoretical outcomes. No scenario follows paper plans perfectly. Reality always adjusts. Still, knowledge remains true power. In every market cycle, action means learning, not constant trading. If you work hard for income, protecting it deserves attention. The coming year demands awareness, not passive hope. Only disciplined, informed investors can navigate it steadily.